Hello, everyone. I'm Maurice White of Maurice White CPA, and this is our continuation of series of informational tax talks that we started back in the early part of the summer. Hopefully, you've been watching the videos where we've talked about several aspects of the new Tax Cut and Jobs Act that was passed in December of 2017. And today, we're going to basically concentrate on the tax rates. We've already talked about the standard deduction and itemized deductions and things of that nature. Today, we're going to talk about the tax rates, which heavily is influenced, of course, by your taxable income. And please understand there's a difference between your gross income and your taxable income, because your gross income is what you actually earn. Your taxable income is after all of your deductions, whether you, well, it used to be if you had dependents, your itemized deduction, standard deduction, whatever. So we're talking about taxable income. And again, there's lots of information here. I'm going to be brief, but it's going to be, hopefully, we'll be a little bit thorough. And this is information. If you need anything else, of course, you'll give us a call and we'll give you that information to contact us at the end of the video. Excuse me. We're going to start out talking about single taxpayers, and we're going to look at the difference between 2017 and 2018. What I would advise you to do, because again, we don't want to spend so much time, pointing out each rate, but what you would want to do is your taxable income, look at it, what it was for 2017, and then what you're projecting it to be for 2018, and find your rate. Okay, so let's just say, for instance, if you were in the 25% tax bracket last year, and you're single between 37,950 and 91,900, you were in the 25% tax bracket. So that bracket basically has been changed to 22. However, it only goes to 82.5. So let's say, for instance, your taxable income was, say, $85,000 in 2017. As you can see, that $85,000 in 2018 would put you actually in the 24% tax bracket. So be mindful. Don't look at this chart and say, oh, 25 is going to 22. You have to look at taxable income. So again, in this case, if you were at, as in that example, if you were at 90,000 or 85,000, you're not going to go to 22, you'd be at 24. So really pay attention to that. The other thing I'd like to point out is the spread in the rates. At 35%, in 2017 or prior, 416 and 418 was 35%. Now in the new law, 2018, 35% is 200,000 to 500,000. So there's a significant difference there as far as basically more folks will be taxed to 35% before they would move into the higher brackets, unlike in the past. Okay, so again, we'll concentrate on our rates. Now let's look at married filing joint or surviving spouse. And this, many folks married file joint returns. And again, you can see the 10% rates basically the same. We want to do the same thing. Let's just say if last year you were in the 28% tax bracket, that's between 153 and 233 in 2017 or prior, and that rate now jumps down to 32. However, that rate is now a little bit larger, from 315 to 400 will be 32%. And again, if you're over 400,000, you're going to be in a 35% tax bracket starting in 2018. Back in 2017, 35% bracket was 416 to 470. So again, find your rate, okay, then look at the new rate and whether or not your taxable income is still in the same place if your income is about the same. Married filing joint. Let's look at the head of household. And the head of household is basically someone that has a qualifying dependent that they're the head of, and lives in their home and they take care of them. So they qualify for head of household. Tax bracket, again, 10% tax bracket, not much change there. Let's look down at the 24% tax bracket. Okay, 24 for 18. 28 in 2017, from 131 to 212 would be 28%. Now, that rate has moved to 24, but only up to 157. So again, be careful. Let's just say you made $180,000, $170,000. Excuse me, your taxable income was $170,000 in 2017. Okay, you would have been taxed at 28%. Now, $170,000 in 2018, you're actually going to be taxed at 32%. So you would actually have a tax increase. So be mindful of that. And as you can see, the rate has spread again with the law is now spreading the people that will qualify for the 35% tax bracket is 200 to 500. 35% used to be only 416 to 444. So again, be mindful of that. Again, find your rate from last year, know your taxable income, and see where you're going to fall. So you need to do some planning. We don't have much time left because the tax year is almost over, and you need to do your planning now. to make some moves if you need to before the end of the year. And again, last but not least, married filing separate. As you can see, 10% tax bracket is about the same. Again, the same thing. If for whatever reason you don't file with your spouse, and this filing status used to be punitive for a lot of folks, and there are always possible reasons for not filing with your spouse. Most of the time, it's better to file a joint return, but there are times when you want to file separate, and sometimes you don't have any choice. But anyhow, let's just say if you were at 33% married filing separate and your income was between 116 and 208, you're at 33%. In 2018, however, 157 to 200 is 32%. So of course there's a bit of a break there because the spread there, it's a little bit more than what it used to be. So again, we want to be mindful of that. And also a good thing, and this is unusual, but the married filing separate rates are basically the same as single. And if you want to see that, here's the single, as you can see, 93 down to 500,000. The married filing separate, 95 basically to 500,000. So exactly the same. However, you can contrast that with last 2017 and prior. If your income was over 235,000, you were at 39%. Under the new law, however, if your income is over $500,000, you're still on 37%. So that's a huge difference there. So a huge tax break for those that don't file with their spouses. Okay, so that's basically the rates. And I know that's a quick overview, but again, we want to give you an awareness. This is informational tax talk, and not to give you tax advice. If you would like tax advice, please free to contact us. You can reach us at something just popped in my head. Sorry about that. But you can reach us at, you can email me at Maurice_W@msn.com, or you can reach us, of course, by telephone, and that's 843-552-2078. And we can speak further if you need to. And again, if you don't want to have an opportunity to speak with us, if you have your own tax advisor, please call them up and ask questions. If you don't have your own tax advisor, then feel free to give us a call. And again, stay tuned. We'll be coming with additional information. And you know that the year is closing very fast, quickly, and there's not a whole lot of time left in order to do some tax planning. So, but again, stay tuned, and we'll talk to you soon. Take care.